Hello, this is Steve Sanangelo from the SRS Rock Report with a new YouTube video update called Why Silver is the Major Investment of the Future. Now, I believe silver is going to be one of the best investments to have in the future due to the US financial system and massive debt heading towards an epic meltdown. And I'm going to show some silver fundamentals, investment fundamentals, and what's happening with the US economy, the debt, and energy, because energy is the major driver of the economy. So let's get started. Now, last year, the US was the number one leading silver, physical silver investor, actually also ETF. So last year, Americans purchased 78.2 million ounces of silver bar and coin. Germany came in second, 42.6. It seems as if the Germans who, kind of remember the hyperinflation that happened in Weimar Germany in the 1920s. So with that pandemic shutdown and all the money stimulus and all the central bank QE, a lot of the Germans started buying a lot more physical silver. And India, unfortunately, India usually is pretty high, but they declined due to the pandemic shutdowns really impacted the rural farmers in India. So they only had 8.7 million ounces, Canada 7.9, and China. China and Asia, they tend to invest more in gold than silver. And so what we're seeing is the US and Germany are the leading silver investors in the world. Now, if we look over a 10-year period, it continues. We could see that the United States, Americans invested over a billion ounces. That's 1,500 million ounces. So it's over a billion ounces of silver investment in the United States, bars and coins. India was 623, but they dropped a lot last year. But Germany's moving up. They're 310, Canada 146, and China 64. So almost if you added all of these, it would equal about 1.1 billion ounces. Everybody else, these other four countries, about 1.1 billion ounces of silver, and the US is 1 billion. So it just goes to show you how strong silver investment is in the United States. And I think it's going to get even stronger. Now, I go into at the SRS Rock Report for subscribers. This is a gold subscriber. I put together the strategic silver market report, investment demand to be the key driver in the future. And I explain why that's the case. And I show that the actual ETF demand, there's a lot of institutions moving into the silver ETF demand. And I think that's going to be even stronger. It's not just the SLV or the Sprott PSLV, it's the ETF securities. It is the Aberdeen silver ETF, and Deutsche Bank has, and we're seeing a lot of silver move into Deutsche Bank's silver ETF, and that's due to more Germans are getting interested in buying silver, and some of them, instead of buying physical, they're going into the ETF. So that's at the SRS Rock Report. You should check that out. Now, the interesting thing that happened last year, basically the world shut down the global economy. And what this chart shows is total world silver investment valued at $100 an ounce. And that's all the silver that you can, investment silver in the world versus the global debt increase in 2020. There's about 5 billion ounces of silver. If we multiply it by $100, we get 500 billion right there at $100 an ounce. Right now it's at 25, 26. But even at four times that, it's 500 billion. This is how much debt the world added last year. 24 billion. The US was almost 1/3 alone. Total debt in the US, we're talking public and private, was about 7 trillion. So now this is a 24,000 billion, 24 trillion. So it just goes to show you right now we're using debt to offset a lot of the problems in the US and global economy. And so silver is one of the most undervalued assets out there. Now, if we look at this Fred chart, total US public and private debt, all sectors from 1950 to 2021, we can see a very interesting trend. It took from 1945, after World War II, it took 40, looks like 35 years to get up to 4.6 trillion in 1980. And by 2000, it was 27.8 trillion. And in 2020, the average for the year, 81 trillion. So if we take the US debt to GDP, now this isn't just the public debt, this is public and private. In 1980, it was 164%, the debt to GDP. In 2000, 272%, and in 2020, it's 387%. It's going to go up even higher, but at some point in time, this whole debt system is going to implode, and that's going to be very good for the precious metals. Now, if we look at this chart, it just goes to show you the debt increase, especially during the pandemic. This is the US GDP versus the US net increase in total public and private debt. 2017 to 2020, this was the GDP. In 2017, the US had 19.5 trillion in GDP. It moved up to 20.6 trillion in 2018, hit 21.4. And they said during the pandemic, can you believe this, that the US GDP only fell to 20.9. That's a half a trillion, 500 billion. I mean, basically we shut down the economy. But if you look here, this is the net increase in total US debt for each year. We added 2.4 trillion, 3.1 trillion, 3.2 trillion in 2019. And look at this, 7 trillion in 2020. And that is what really helped prop up the US GDP and keep it from really collapsing further. So now if we look at the total net increase in US public and private debt, which is in green, this is, well, that's in red, and the net increase in the GDP. So what we have in the green dollars is the actual increase in the GDP in trillions. So this is 0.8 trillion. It increased from 2016 to 2017, 0.8 trillion, 800 billion. It increased 1.1 trillion in 2018, 0.8 trillion in 2019, and it fell a half a trillion in 2020. And you can see that right here. It fell from 21.4 to 20.9, a half a trillion. So these are the increase in the US GDP and then the decrease during the pandemic. Now, if we compare the actual increase in debt, total debt in the US, it increased 2.4 trillion in 2017, 3.1 trillion in 18, 3.2 trillion, and 7 trillion in 2020. So we added $3 in debt to get $1 in GDP in 17, $2.8 of debt to $1 in GDP in 18, $4 of debt for $1 of GDP in 2019. And here's the clincher, $14 of debt to $1 GDP. Why? Because we lost. The net increase was a loss. So you divide 7 by 0.5, it's 14. I mean, that just goes to show you how much the US government and private sector, the banks, are propping up the GDP. Now, if many of you follow the SRS Rock Report, I tend to talk about energy because energy drives the economy. If you're sick in bed, I keep saying this, if you don't have the energy to go to work, you can't earn your living that day. If you don't have gasoline in your car, you can't get to work. If you get to work and you work in a manufacturing plant and they don't have electricity going to the manufacturing plant, you can't produce any goods that day. So it takes energy to produce all this economic activity. Now, what this chart is showing is total US public debt versus the US GDP and total energy consumption from 1966 to 2020. This is the energy consumption in quadrillion BTUs. That's a big number. And that is shown in the yellow line from 1966. The GDP is in the blue line. And then the debt here is in the red line. And both the GDP and the debt is in the billions. So what's interesting that I found that from the 1966 and prior to up to 1980, the increase in the GDP, which is the blue line, was driven by, it was energy driven. And we know this, that the energy increase in energy consumption should relate to the increase in your GDP. But now we could see we had the 1980s recession, but oil energy consumption increased, but also did the debt, because the debt really didn't go up that much. It started really going up in this 1980 to 2000 period. So the GDP, as it was going up, was driven by energy and debt. Now, if we look at 2000, this is a fascinating thing. Basically, since 2000, we had a little bit higher move up in 2008, but it has been, our energy consumption has been in a plateau since 2000, 20 years. But look at the GDP, it's gone up all the way to here. But unfortunately, the GDP has been driven by the massive increase in debt. So if we look at these three different periods, energy increase consumption was the main driver of the increase of the GDP. Then from 1980 to 2000, it was energy and debt. And because energy remained the same in a plateau, it's been the debt. And I showed you here, just in these 4 years, how much we're adding debt just to get an incremental increase in GDP. Now, if we look, I can show you right here. This is the energy consumption, 987 quadrillion BTUs. Look, it's actually less in 2020, but look at the GDP. It's 20.9 trillion, even though it fell a little bit. It's more than double than it was in 2000. But the US public debt, I'm just talking US, just the public debt has increased 5 times, because it went from 5.7 trillion in 2000 to 27.7. So it's nearly a 5 times increase. So what we're seeing is that the debt is now what's driving the GDP, or pushing the value of the GDP, because it should be energy consumption. But we could see here, the energy consumption has been flat or even declining a little bit. So this GDP is inflated due to this massive debt increase. Now, why is that trouble? Because I study what's happening with oil production, because without oil production, you can't extract coal and you can't produce natural gas, because it takes diesel, moving equipment, mining equipment to extract the coal. Then once you get the coal extracted, you put it on a train, and it's a diesel engine train that ships that coal to the coal fire plant. And it takes a lot of equipment and trucks to produce natural gas, shale gas wells. So if oil gets into trouble, so does the coal and natural gas. And we saw that in Venezuela. But also, you need oil, natural gas, and coal to produce wind and solar power. And that's the problem. So when oil gets into trouble, all the other energy sources are going to get into trouble. Now, this was total US crude oil and condensate production from 1915 to 2021, and it's my forecast to 2025 to 2035. We peaked in 2019 before the pandemic, 20.25, and now it's a little bit more than 11 million. But I forecast by 2025, it's going to be 7.5 million barrels a day. By 2030, US oil production will be down to 4. And by 2035, it'll be down to 2.5. And if we look, if we remove the shale, this is the rate. Now, the reason why shale is not going to last that long has to do with this. I subscribe to Shale Profile. It's a very expensive service, but I could look at every well, the details of every well. And these are the top 4 shale fields. This is the Bakken, the Niobrara, and this is the Eagle Ford here, and the Permian here. And these are the top 8 companies shale oil production declined from December 2019 to April 2021. I removed 2020 and 21 just to show you this decline rate. So in just a year and 4 months, this production that was brought on at the end of 2019 reached 3.489 million barrels a day. And that's just from these 8 companies, these 8 top companies. 3.48, it's fallen to 1.6 million barrels a day. That is a 54% decline in 1 year and 4 months. It's a little less than 50% decline every year. That's what it is, about 48%. So every year, the shale industry is losing 48% of its production. And the only way it could do that to add production and build it is by this massive increase in the number of wells. But at some point in time, we're going to run out of locations to drill. And we're going to see production plummet as I showed you here. Now, this is my estimate. I could be off a little bit, but I'm found another oil person at the peak oil barrel. His name is George Kaplan. He put together, this is the US LTO, which is light tight oil shale production. It's production and reserves. The reserves are shown right here. And this is the production. And this is where it is presently. He also sees the production collapsing by 2030, down to here, down to almost 1 million barrels a day. People don't realize how bad that's going to be for the US economy. Because right now we're exporting oil, we're living on this oil that we're producing. And what happens when we lose this much oil? We go from 11 million down to 4 million in just 9 years. People don't realize, and then the Russia is also looking at peak oil. The Middle East is in serious trouble. So the world is in serious trouble with production. And if it wasn't for the shale industry and the Canadian oil sands, we wouldn't have added 10 million barrels of oil production growth since the financial crisis. You can thank the U.S. shale industry and the Canadian oil sands, but guess what? That's not going to be repeated. And that's the problem a lot of people don't realize. So the next 10 years, this next decade, we're going to start seeing declines in global oil production. And the world isn't prepared for that, because the only way to prop up all this debt is you have to have more oil production. That's the only way you can do it. So I talked about the growth, peak, and collapse of ancient civilizations. I talked about the late Bronze Age. I've got a chart showing the late Bronze Age, the Roman Empire, the ancient Western Roman Empire, and even the Mayan Empire. And I showed how their growth and peak took place over a period of time, and then their collapse was very sudden. So if you look at our modern high-tech world, what does that show? And I also showed this for silver members at the SRS Rocker Report. So we need to realize it's important if we're precious metal investors. A lot of people get frustrated when they see the price of silver or gold fall. They shouldn't be. That's a better opportunity to buy more, because energy drives the global economy. Financial markets steer the economy. Financial markets do not drive the economy. As I mentioned before in several interviews, it wasn't the Fed Chair Bernanke doing QE since the 2008-2009 financial crisis that got us out of that financial collapse and recession. It was the 8 million barrels a day of U.S. oil production growth. You need the energy to back it up. We're not going to have that this next decade. That's over. Now, gold and silver are stores of energy equivalent value, and that's the reason why silver and gold are the key assets, especially silver, because there's not that much silver. There's about the same amount of silver investment bullion in the world as there's gold, about 1 to 1, and not many people realize that. So if we're going to get in trouble with oil and energy, that means stocks, bonds, and real estate they're going to get in trouble because they're not stores of value. Their values are based upon energy growth. And if you have energy declining, they become energy IOUs because a 30-year mortgage needs 30 years of economic growth so the person can pay that mortgage off. What happens when we start seeing declines in oil production, energy production? Real estate prices are going to collapse. And I'm going to provide the SRS Rock Report Gold and Silver members with this information in upcoming videos and presentations. Even though we're seeing high prices in the U.S. stock market, in the U.S. real estate market, that's going to collapse over the next several years, and it's going to just get worse by 2030 and 2035. So gold and silver are stores of energy value, whereas most stocks, bonds, and real estate are energy IOUs. And that is the fundamental reason why it's important to own physical precious metals. Now, this was one of the things I showed in that silver strategic market report. And something happened in 2020. This is total silver investment demand versus total silver industrial demand, 2012 to 2020, and forecast for 2025. All what we could see right here, this is the total silver investment, and that's including ETF demand, Well, look what happened in 2020, 532, almost doubled compared to the other prior years. And for the first time ever, silver investment demand total, bars and coins and ETF, surpassed industrial demand of 476 million. So that means also in 2020, investment in industrial demand, which equaled 1,008 million ounces, was 128% of global mine supply. And we also have to factor in that there was jewelry demand, even though it was lower, there was photography and silverware demand. So what happens, I think, if we get 600 million in industrial demand, and forecasts are say that we are going to reach that, and that's green energy, more EVs, battery production, a lot of more high tech is going to consume more silver. So by 2025, it could hit 600 million. And that at the same ratio in 2020, investment demand would hit 675 million. That's physical and ETF, especially as the central banks say they're going to go to their own digital currency, like the Fed coin. And that's going to be real, and that's going to be, we're talking about inflation, that's going to be super inflation when the Fed can send money directly to Americans without having to go to the Treasury to increase the debt. That will be real money printing. So by that time, and they say this is going to happen 2022, 2023, 2024. So 2025, we get to 1.2, 1.3 billion just for these two sectors, investment and industrial. You still need jewelry, you still need silverware, and you still need photography. This silver the price of silver is just going to get stronger and stronger and stronger as time goes on. And most of it, the key is going to be investment demand. Because right here, investment demand was higher than industrial demand, and it has never been that before. So I wanted to show you a quick update on the Silver Eagles. It was interesting the last few months, they have the new design. They went with the new design, and that was an anti-counterfeit design. So it took a little bit longer to get them out. But so if we look at January to July 2020, and this was also cut back due to the pandemic, there was 13.7 million Silver Eagles sold. January to July 2021, 18.2 million. Big increase. So I think we're going to see, if we continue to see strong sales the remainder of the year, we're going to easily be 30, 32, 35 million Silver Eagles sold. And what's interesting, The Gold Eagle sales for January to July have really picked up. They were 414,500 ounces last year. This year so far, there's 701,500. So they're selling a lot of Gold Eagles. I think investors realize, even though we're not as spooked as we were during the pandemic shutdowns, but I think investors continue to acquire Wall Street. I mean, the Wall Street Silver campaign. They are also pushing their followers to continue to acquire silver. So I think we're going to see strong demand for silver, and it's just going to get stronger as time goes by. So I really believe the US financial system and the massive debt that's propping up the entire system is heading towards an epic meltdown. And why? Well, if the Fed and central banks can prop up the markets by doing QE, buying treasuries, buying mortgage-backed securities, well, they could do it forever. The problem is you can't do that with oil supply falling. And the perfect example is Venezuela. Their oil and energy production, even their electricity, when their oil production fell, so did their electricity production. And look, they went into hyperinflation. So when you start to see the US and global oil supply start to fall, it's going to destroy the whole debt that is propping up this system, because it can't maintain it. And that's when you're going to have a collapse in the currencies. That's why it's important, not for tomorrow, not for next week, not for next month, even next year. It's important to acquire the precious metals, especially silver, over the mid to long term. Because I can tell you, since the last 2008-9 financial crisis, we go 11 years, the world's going to be a totally different place. We're not going to have the energy this time around. We're going to start seeing falling energy production. Well, I thank you very much. And please share this if you like it, please hit like and subscribe to the SRS Rock Report YouTube channel. Thank you very much.